Okay, everyone. So I'm going to go over the ES gold and crude, and just show the how it turns. All right. So we have ES. I'm going to start at the low today, the low of the trend today. This is an intraday trend, and below here is just volume-based studies. So this is just volume-based studies. All right. It's very basic volume-based studies. Anyway, so over here, the market starts moving sideways, and here you have your first rally. Now, this rally, anytime there's a rally, it has to be on good volume. All right, if it's on crap volume, it's not a rally. It's somewhat it's suspect. All right, because the cause and the effect are not lining up. In order for price to go up, there should be volume coming into the market, forcing the price to go up. So if price goes up without volume, it's like an effect without a cause. The cause is volume, the effect is price. So that's why it has to have a volume, otherwise there's something not right. So you have to know that. And this is why you have to study volume with price. It does not make sense to study price by itself, because there'll be too many issues. So it just doesn't make sense unless you see the volume pushing price in a certain direction. At least it makes more sense when you see this. See, like 30, that's 30,000 contracts, which explains this rally, right? This breakout, that explains it. So you have this rally on 30,000 contracts, pull back on only 5 and 9,000, which means there's no supply. Then the next rally on 49,000 contracts, that makes sense, right? Then pull back on 5,000 contracts. It does all this back and forth, back and forth. But then it gets a little interesting in that the up waves, they lessen a bit, 20,000 and 14,000. So, we have to examine that. And then again, the next rally, which the indicator caught as climactic, it moved up, but it didn't pull back any. So, if you understand that if the market doesn't pull back and just keeps on going up, there's a problem. And so this was climactic. It had 37,000 contracts, but still I'm not bearish at this point. It just means there's a lot of volume. That's all it means. So I don't care if there's a lot of volume. It just means that maybe they're getting excited and keep buying the highs. That's all it means. But the next move was the big problem for the bulls. Why? 32,000 contracts sell right here. 32,000 contracts. If you look at the background, 10,000 sold, 5,000 sold, 9,000 sold, 5,000 sold, 10,000 sold. All of a sudden, more than tripled the amount. 32,000 contracts sold from the highs. All right. So basically, it's the concept of climax automatic rally, which is really climax change of behavior, or climax sign of strength, or climax sign of weakness. That's automatic rally is nothing more than a change of behavior. All right, automatic rally after the climax. So typically, the automatic rally in Wyckoff occurs after one of two things. One is shortening of the thrust, and the other is the climax. So this is the climax model where there's a climax and you have the change of behavior, but it can also occur, and I'll show this, I think somewhere I have an example today, where it comes from a shortening of the thrust, or a lack of demand. It can come from that as well. Anyway, bottom line is it's very easy to detect that there's a lot of selling pressure right here. As the market moves up and up and up, over here, the selling pressure comes. 32,000 contracts sold from this high. Now, does that mean you automatically short? The answer is no, because you have to wait for demand to prove it has exhausted, meaning no more demand. It proves it right here with 6 and 10. These numbers are very low. 6,000 is less than the prior 37, 14, 20, 49, 10, 30. It's less than the entire trend. So that is your indication that buyers exhausted themselves on this upwave, on this climactic move, on 37,000 contracts, and that they're done. So now you're in a position where you have supply and you have a weak demand, which results in downtrends. That's how it happens, right? That's what's called an imbalance and favoring supply now, because you have 32,000 selling pressure and only 6,000, which is about 1/5 of the supply. Demand is 1/5 of the supply. So there's that selling imbalance, and that's going to create a downtrend. And if the demand doesn't come in, it's going to go down. At least the situation says that supply is in control because there's much more supply than demand, and that will result in price declining. So anyway, this was clear, and the only one thing that was not clear was that, well, actually two things would have helped even more, and that's if they took out the demand last wave here. If they took out this low in the volume, like heavy pressure broke it. And second is if there was more evidence of distribution. If there was more evidence of distribution up here, that would have got me really bearish. So over here, because over here you have 73,000 and 36,000, and it went higher. And if here there was evidence of distribution, it's game over. Because overhead distribution explains that, why price rallied away from it, because they sold into any demand up here. Anyway, bottom line, to make it really simple, you see this crack. This is almost like looking at a breakout or a breakdown. You have a line that represents the average. This is something I put together, by the way, so I can visualize the supply demand clearly. Right? So I have the line here that represents, you can consider it like an average, but it's also almost thinking like a support. Like that's the average volume, but it's almost like a support. And when you break below it with volume, you have a breakdown. You see? And here in sideways move, when you break above this, it's like a resistance. Cracks resistance, volume cracks resistance. So I'm using the averages. This line is the average of multiple up waves, and it cracks or breaks out above it, and here it breaks down below it like a breakdown, like a breakout and a breakdown. But I'm just using averages to synthetically create that concept. Right? So it's like a break, heavy volume, cracks, that's, you could consider it support or whatever, that threshold, and price goes down. Now here again it gets interesting, right? Over here, okay, hang out, supply is in control, volume picks up, but it doesn't crack yet on the demand. It does not crack through this until this. See this? Now I don't want to be short. Alright, because this cracks through that volume average line or the way I see it as a volume resistance line, completely and thoroughly crack. And the supply response is very average. So now I'm not into shorting the market because demand is in control. That's a quick lesson on just how I've tailored this supply and demand, and synthetically use their averages to represent almost like a breakout and a breakdown, and it works. It's you have this, it's less, and crack. You see it here, less, crack, breakout, ooh, breakout, break to the downside, turn the trend, break, buying activity. What is it forecast? Higher prices to come. That's what I believe, unless we have a supply that breaks this low. All right, so now let's move to gold. All right. So, I mean, go down, don't do shit. You don't do anything because the selling is stronger. Right? Selling is stronger until this level. Right? See this level, 85,000? That's a clear crack above that volume resistance or that volume average. And yeah, I mean, you could say that it's too late right now because it already went up. But so you just wait for the pullback. You wait, and volume is showing its strengthening here. It's cracking through, right? And there's something else you can use this. I mean, if you see the volumes of the supply, 43, 41, 33, 10, do you see a pattern? They're decreasing, right? So now, if you're still not sure, just wait for the rally indication. Here's a clear crack right there, 56, right there. See? And clear crack. This is bigger than 1, 2, 3, 4. 1, 2, 3, 4. It's cracks. Supply weakness in the background. Pressure breaks through on, this is 5,600 contracts, right? 5,600 contracts. So they're done reaccumulating. And also I know they're done reaccumulating because in the background here, I see this. Yeah. And what happens as a result of this volume? Price goes higher. This means that this volume is demand. This demand caused price to go up. The demand comes in, price goes up. Supply comes in, price goes down. But you don't know this until it moves. Otherwise, I'll have to go into like lower time frames and do all that crazy analysis, and I don't want to do that, right? I just want to see the crack and get in on the pullback. So this is the accumulation, and this is the crack, and it's very clear. This is the breakout right there, right? That's the rally, and there is a pullback. Tap it and go. Now, if I'm looking for a short, if it goes to a level, I'll just look at the supplies. Okay, nothing, bingo. Here we have a little problem, right? Here we have a little problem right here. Cracks through. It's not a major crack, not a major break down, but I don't want to be in long if this thing comes in. So when it comes in, it means that it can react, and it did react, but we see that the reactions are losing selling pressure from 49,000 to 36,000 to 19,000. That's an indication that selling pressure is weakening. And buying went from 17, 18 to 36. Oh shit. Buyers are stepping in. And now, if this thing is set up, this is real time, by the way. This thing is set up. This is the early indication that buying is coming in. I'm not saying I'm ready to long, but it goes above average. It's like a little breakout above average, and the selling pressure is weaker than average. So that sets up a condition for a rally. So that doesn't mean I get in. I wait for the rally, then get a pullback. All right. All right. And over here, I don't really see much. Right. Now, if there's no rally, just wait to see if it cracks to the downside. That'll tell me what I need to know. All right, let's move on to the next. Which one was this? Oil. All right, oil. Let's measure this. All right, so it's coming down from 12500 contracts, 7300, 3900, 5900. Where do you see the crack to the upside? You'll see it right here, 64, crack, right? Crack, right there. That crack is like a breakout, but with volume. And as I explained for the third time, I'm using the average volumes as synthetic support and resistance. And this idea occurred to me, and at first it didn't make sense, but it started working. So I mean, it just means there's a lot of demand coming in. If you have a lot of demand, it's going to go higher, just like a breakout. If you have a lot of supply, it's going to go lower, like a breakdown. So anyway, so this is the clear crack, like a breakout. Boom. Now we wait for the pullback, weak pullback. This shit is going up. It's going up. And crack. So here, I don't know why I don't have it here. The rally should be here, but I don't know why it's there. Anyway, so you have a rally, you have this 66 cracks through. Continue cracking. Here, I have to be concerned. If I'm long, I need to know what is this. All right, so I circle it. Because this is low, breaking down, meaning lower than 1, 2, 3, 4, 5 or 6 waves, and it's also coming off of a resistance level. Does that mean I go short? No, I want to see the response. If demand has a weak response, supply will take it lower. But we see that demand said, I am stepping in. You are not going to bring the market down. Demand stepped in, 118. So we back off. You know, if you're short, if you're long here, I want out. I don't want to, hold and hold and hold. But because this is a heavy selling, I went out. But I'm looking at that pullback to see if it's weak. If it's weak, then you have a chance for a downturn. But is it weak? No, it's extremely strong. It's bigger than 1, 2, 3, 4, 5, 6, etc. 118, 100 contracts, greater than 54, greater than 68, greater than 50, greater than 66, greater than 26, etc., etc. And the response from supply is half now than it was before. Before it was 100 contracts, now it's 3,100 contracts. So I know that these guys failed. The supply here failed. It failed to break the trend because demand stepped in, so they backed off, and price, I'm watching price, I'm watching volume, ding, 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 ding. It's still strong. See, it's much higher than the average line. So it's like a breakout again. Continue, continue. Do not be afraid of any of these little corrections because they're not breakdowns, because They're not excessively breaking down below that average line. It's like almost like a support. You think of it like that. And again, bang, cracks right through. 8,700 contracts. Here it's getting a little interesting. Here the supply is getting interesting because it cracks through the line. And this is the greatest supply in 1, 2, 3, 4, 5 waves. Now, and it has a weak response, 14. See that? So 43 bigger than 1, 2, 3, 4, 5, and a weak response. So it doesn't mean I automatically short. I want to wait to see what price does if it breaks down also. And if the supply increases while demand decreases, setting up the turn. All right, folks. Oh, one more thing. I want to see if there's any distribution. And there is potential distribution right here. Maybe this one, like up here. Up here at these levels, you see this? Someone is exiting their position or shorting. Just like here, they were accumulating. See this? This is all the way back here. They were accumulating. Look at this. Look what happened. Now, these guys are at the high, selling up here, and we'll see what happens. If it cracks, great. Great for the short. Great for the bears. All right, that's it. That's all, folks. I hope you all learned something, but this is how you read supply and demand.